Lines in the market seem to be triggered by hopes of a rate cut. A lot of signs point to this being a positioning-driven technical squeeze. Joining us at Post 9 as well is Barclay's head of U.S. equity strategy, Venu. Krishna recently raised his forecast from 5,300 to 56. Great to see you, Venu. Welcome. You want to weigh in on the impact of these unwinds?
Yeah, so I think our view is that while the catalyst was a soft CPI print, which increased the likelihood of rate cuts, but that doesn't really tell you the story, because entering into this whole rotation, already the likelihood of a cut was close to 75%. All that's happened, it's gone well over 90%, right? So, but if you dig in deeper, positioning, for example, within big tech was at extreme, both real money and fast money getting in. If you looked at what drove the returns in June and July, it was the substantial move in big tech, driven not by earnings, but by a substantial expansion of multiples, going from around 27, 28 times to 34 times, which we felt was unsustainable. But you flip it, and then you see the move in Russell, which is the most perplexing. The correlation between Russell on an absolute basis and a relative returns to S&P has been highly negative to interest rates. So it's not surprising that when your two-year rates goes down 40, 50 basis points, then that it does lead to a rally in Russell. But I think, again, that also fully doesn't explain what is happening. I think if you look at some of the moves in derivatives markets, you have this unique situation in small caps of spot up, vol up. In other words, small caps are up, but their vol is also up. At the same time, and that is not supposed to happen. Then you have a significant increase in call volumes versus put volumes, which is leading to a flattening skew. Again, pretty rare for a move of this magnitude, right? So I think we are seeing a lot of hints in terms of movements which clearly point to a significant technical unwind. For example, on systematic side, CTAs were very underweight Russell, and they were overweight S&P and NASDAQ. In a matter of 2 weeks, they've dramatically changed, and now they're actually pretty light on NDX and pretty significantly heavy on RTY. And my point is the reverse can also happen as fast, right? So I think our point is you need to tread carefully. And as far as the rotation is concerned, the single biggest standout is not so much momentum, is not value growth, is not so much the SPW story, it is size. If you look across the 3,000 stocks, the single variable which stares at your face across the board is size. And if you break it down in deciles, so you break it down into lots of 50, there's a very, very clear relationship between. And the last point I will say is that it is not just a junk rally. What you find if you dig deeper is that there's a quality bias. In other words, there is a certain method behind the madness as well. So these are very interesting times.
Is it a long way of saying that this whole thing may be a head fake?
Yes, we do think it's not sustainable on a fundamental basis, right? So one of the arguments coming in was small caps were historically cheap versus large cap. By our analysis, that gap has predominantly vanished now. They're pretty getting to par levels. Second, if you look at earnings growth, for small caps, the forward revisions are still negative to modestly flat. For large caps, it's up 5%. For big tech, it is up 20% after the first quarter earnings. So that doesn't give you support. And finally, if you look at what the consensus numbers are, I think they're way too optimistic. They are expecting not only a ramp in margins for small caps, exceeding that of large caps, but that to drive a significantly faster earnings growth for them over the next 3 or 4 quarters. I think that is too wild an expectation. And so we feel that this rally can last a little while, but eventually it has to peter out. And so the last point I would say is that everybody points to the fact that rate cuts and then small caps benefit the most. But if you look at the last 13 interest rate cutting cycles, small caps have never done well. They've always lagged. And the only time in 95 when they did do well, when we had a soft landing, was a time in which they were ahead for about 2 months and they gave it back.